Hey everyone, welcome back to Corporate Decoder, the place where we break down the SEC filings so you don't have to. This time around, we are diving into Alussa Energy Acquisition, Corp. It's whose latest quarterly report, a company that probably still has its eye on that big merger. This report seems to be all about setting the stage and handling the aftermath of a major financial event. So let's see what the numbers telling us about this company's journey. Before we dig in, if you want to stay ahead of the curve on corporate finances and business strategies, make sure you are subscribed. And hey, join our Discord community. We have linked in the description below. It's a great place to share insights. So, Alussa Energy Acquisition Corp. The Q, Form 10Q, for the quarterly period ended the 30th of September 2025. This is essentially a check-in on how the company is doing after a busy period. And right off the bat, you're going to notice this company is in a very specific phase of its life. They tell us right here, as of the 15th of December 2025, they have a certain number of Class A and Class B shares out there. This is important context for understanding their ownership structure and how their initial big event, the IPO, played out. Now let's look at the big picture, a quick peek at their balance sheet. Remember, this is as of the 30th of September 2025, and then comparing it to the 31st of December 2024. Notice this line item deferred offering costs. It went from about $618,000 at the end of 2024 to over $1.4 million by September 2025. This tells us they were spending a lot of money preparing for something big, likely their initial public offering, even though it officially happened in November. And look at accrued offering costs. It shot up from around $600,000 to over $725,000. These are costs they incurred but hadn't fully paid yet, again pointing to that IPO preparation. Their total liabilities also grew significantly from around $670,000 to over $1.5 million. This jump is largely due to that deferred legal fees number, which went from nothing to nearly $700,000. This suggests a big legal push probably related to getting ready for their public debut. It shows they are investing heavily in making sure everything is legally squared away. Then we see their Class B ordinary shares. There are a lot authorized but a specific number issued. The footnote here is critical. It directly mentions up to 937,500 Class B shares subject to forfeiture if the over-allotment option was not exercised, but then it happily states that on the 14th of November 2025, they closed their initial public offering and no longer had those shares subject to forfeiture. So that particular risk was cleared. This is what we call cleanup after the IPO party. Moving on to how they are doing in terms of making or losing money, their statements of operations. For the 3 months ending the 30th of September 2025, they reported a net loss of about $15,000. For the 9 months ending the same date, the loss was around $17,000. And for the initial period from when they started in August 2024 until the 30th of September 2024, the loss was about $37,000. These numbers are tiny, which is expected. They are a special purpose acquisition company or SPAC, and their main job is to find a business to merge with. They are not really operating a business yet, so these costs are mostly for staying afloat and getting ready for that big merger. The weighted average shares outstanding also shows a small number around 6.25 million. The footnote here again refers to those Class B shares and their forfeiture, confirming that those were not counted as outstanding for these calculations yet, but were eventually cleared. Let's check out the cash flow statement, which shows money coming in and going out. The net cash used in operating activities for the 9 months ending the 30th of September 2025 was about $105,000. This is essentially the cash equivalent of their reported net loss, plus some adjustments for how they track expenses. It shows they are spending money to keep the lights on. On the financing side, they had proceeds from a related party loan of over $101,000. This means money came in from someone connected to the company, likely to fund their operations before the IPO cash hit. And their cash at the end of the period, the 30th of September 2025, was only $520. Compare that to the 31st of December 2024, where they had $4,200. This drop shows they were burning through cash in the lead up to their IPO. Now, let's get into the notes to the financial statements. This is where the company explains what is really going on. Here they clearly define their sponsor, Alussa Energy Sponsor II, LLC, as an affiliate. This is a common structure for SPACs. This is a big one. They clearly state that on the 14th of November 2025, they completed their initial public offering selling 28,750,000 units at $10 each. This is the core event that brought in the main influx of cash. But as always, there are costs. Transaction costs were nearly $11 million. That includes cash underwriting fees, but a huge chunk, over $8.6 million, is deferred underwriting fees. This means the underwriters get paid that massive amount only if the company actually completes its business combination. It's a big incentive to get that deal done. This is crucial for SPACs. They placed a massive sum, $287,500,000, into a trust account. This money is to fund the acquisition and is generally protected from company creditors until the deal closes or the company liquidates. It sits there earning a little interest from safe investments like US government bills until it's time to merge or return the funds. The company has 24 months from their IPO closing date to find and complete a business combination. If they don't, the money in the trust account gets returned to shareholders. This deadline is a huge driver for SPACs. They need to find a deal and get it done, or everyone loses their initial investment, except for the sponsor who might forfeit their founder shares. This section explains how they do their accounting. For most of us, the key takeaway is that they follow us generally accepted accounting principles, or GAAP, and that these are unaudited interim financial statements. They also highlight that they are an emerging growth company, which means they get some relief from certain reporting rules compared to bigger, more established companies. This can simplify things for them, but might mean less detailed information for investors sometimes. And on net loss per S-share, it is practically zero, as we saw with their tiny net losses. This is typical for pre-busyness combination SPACs. This note reiterates the details of the IPO, confirming the 28.75 million units sold at $10 each, and that each unit came with one class of share and 1/3 of a warrant. Here we see they sold 2.5 million warrants to their sponsor for $1 each, in a private placement alongside the IPO. These are also exercisable at $11.5 per S-share. This is where we see the sponsor and insider dealings. On the 6th of September 2024, the company issued founder shares, 7,187,500 of them, to an affiliate of the sponsor for just $25,000. That is less than half a cent per S-share. These shares are essentially a stake given to the sponsor for getting the SPAC off the ground. They automatically convert into regular class of shares when the business combination happens. The crucial point is that the sponsor, by paying so little, has a huge incentive to push for a deal, even if it is not the best for regular shareholders, because their profit potential is massive. They also took out loans from an affiliated entity, initially up to $300,000. By September 2025, they owed about $126,000. This is typical bridge financing before the IPO cash is fully deployed. This section discusses agreements and potential future issues. This note talks about the underwriter's deal, including that deferred fee of $8.6 million. Remember, this is paid only if they close the deal. It also mentions a 3% advisory fee, another incentive for the advisors to help get a deal done. They also have deferred legal fees, with almost $700,000 owed to their lawyers, only if the business combination is completed. Everyone involved has a big stake in making that deal happen. This breaks down the shareholder equity. They have Class A and Class B shares authorized, but as of the 30th of September 2025, there were no Class A shares issued yet. Only the Class B founder shares. The class of shares are planned for us in the IPO and for the business combination. As of the 30th of September 2025, there were no public or private placement warrants outstanding. This means that while they were issued as part of units and private placements, they weren't exercised yet. This is a standard section for larger companies here. They state they have only one reportable segment, which is basically the SPAC itself before it finds a target. And this is key. Events that happened after the 30th of September 2025. This note confirms the successful completion of the IPO on the 14th of November 2025, gathering $287.5 million. It also mentions the private placement of 2.5 million warrants. This part is management's narrative about the numbers. They reiterate that they are a blank check company looking for a business combination and that they are preparing for the IPO and its aftermath. They also mention new SEC rules for SPACs that could make things more complicated and costly. They admit they have no revenues yet and just had minimal losses from general and administrative costs. This is all standard for a SPAC in this phase. This section talks about their cash. After the IPO, they have a much better financial position with over $287 million in the trust account. They believe they have enough money to operate and fund the business combination within their time limit. This is where they list all the things that could go wrong. There are a lot of them for a SPAC. One big risk is that you might not even get a vote on their chosen business combination. They can sometimes proceed without a shareholder vote, which means investors might not have a say in the deal that determines the future value of their investment. This is the classic SPAC risk. They might just run out of time to find a deal. If that happens, the money in the trust account is returned and the warrants expire worthless. This section highlights a critical point for investors the sponsor paid next to nothing for their founder shares, which represent a significant chunk of the company. This means the sponsor stands to make a massive profit even if the stock price falls after a deal, creating a potential conflict of interest. They might be incentivized to do any deal rather than the best deal. They also talk about the private placement warrants, which are similar to public warrants but with some different restrictions. The whole process starts with the IPO registration statement, which details everything about the offering. This is the company's governing document, outlining its rules and structure. As expected, the net loss per S-share is negligible, basically zero because they are not operating a business yet. So, what is the story here? Alussa Energy Acquisition Corp. The Suki is a classic SPAC that has successfully completed its IPO. The main narrative is about bringing in capital, incurring costs to get there, and now facing the critical pressure of finding a business to acquire within a set time frame. The financials show a company essentially holding money, managing operational expenses, and dealing with the costs associated with going public. The risks are numerous, centered around executing that crucial business combination. They have lots of money in trust, but the clock is ticking. The sponsor has a massive incentive to get a deal done due to their negligible initial investment in founder shares, which could create a conflict of interest. Investors are essentially betting on management's ability to find a good business and execute a merger successfully before the deadline. Thackeray's situation. Do you think they will find a good deal, or is the clock running out for this SPAC? Drop your thoughts in the comments below. If you found this breakdown helpful, please hit that like button and subscribe for more deep dives into company filings. And as always, join our Discord community linked in the description for more discussions and insights. Thanks for watching, and we'll see you in the next video.